Hi, I'm Certified Financial Planner Jim Tewalt, and last year I made the cover of Retirement Advisor magazine for my idea of just think, don't follow the herd. We're going to be doing a web series on a number of financial topics of general interest, and we hope that you'll tune in on a weekly basis to find out how to do a number of things, such as how to purchase life insurance, how to invest in a way that really can work well for building retirement income, and a number of other topics of interest. People buy life insurance for a number of reasons. When you're younger, usually there are three reasons for owning life insurance. One of them is to pay off final expenses. If the breadwinner in the family dies prematurely, usually there's funeral expenses. Sometimes pay off a mortgage, or maybe pay off some student loan debt, or to provide money for the kids' education. These are some of the reasons that people buy life insurance. Another reason that people buy life insurance is to provide for income for their spouse, for a surviving spouse, usually out to the time that Social Security benefits would be available. And that would be to age 60. That's the earliest time that a spouse can get Social Security benefits from a deceased worker. Age actually 56 if you're disabled, but normally age 60 for the retiring spouse of a deceased worker. The third reason that people buy life insurance is to provide income to their family during the period of time when the kids are growing up. So up until the point that the kids reach age 18, normally there would be Social Security benefits there, but again, if the breadwinner in the family dies prematurely, the family could suffer a loss of income. So that's one of the reasons that people buy life insurance, is to cover that. So those three things are pretty normal for younger people. When the kids are grown, there are other reasons for continuing to own life insurance. One of them is to provide or to guarantee the retirement to the spouse. So again, if you're in your 50s or 60s, you pass away prematurely, your family, your spouse may not have had the time to prepare adequately for retirement, so your life insurance benefit can help secure your retirement for your surviving spouse. Once you're retired, when one of the spouses pass away, sometimes that means a reduction or a loss in a pension benefit, and it always means a reduction in Social Security benefits, because one of the Social Security benefits is going to go away, either the benefit for the spouse or the spousal benefit. Usually the surviving spouse, and always the surviving spouse, will take the benefit or retain the benefit that's the largest of the two. So when it comes to buying life insurance, here's a mistake that we see a lot of people make because they just don't think. What they do is they buy the most inexpensive term life insurance that they can possibly buy. And everybody understands that life insurance, when you're younger, you feel like you are 10 foot tall, bulletproof, never going to die, but it does happen for some people. So this is a rate sheet for a life insurance policy that one of our clients bought years ago. It was $500,000 of life insurance for 30 years, and at that particular time, the premium was $630 a year for the next 30 years. Pretty manageable premium for $500,000 of coverage, especially at this gentleman's age. But look what happens to the premium in the 31st year. It goes from $630 a year to $29,860 a year, and then goes up every year after that. So do you think you're going to keep your life insurance policy in force in the 31st year? No, that's not going to happen. So what can happen when you buy term insurance when you're younger? Well, when you're younger, generally you're in great health, and the insurance premiums are very inexpensive, but 20 years later, 15 years later, 30 years later, your health may not be what it was when you bought the insurance. In fact, we have clients that are going through that right now. They were in great health when they bought their term life insurance, but now at the renewal, their health is not so good anymore, and suddenly they're faced with having to pay some higher premiums for that insurance. So how can you avoid that? Well, if you just think, there is a way to get around that, and it's a way that we use very frequently. It is to buy the type of term life insurance that is built on a universal life chassis. Now, what does that mean? Well, universal life insurance is a type of life insurance that you can adjust the premiums, you can adjust the amount of coverage, and you can adjust the length of time the coverage stays in force. If you buy that type of insurance as term insurance when you're younger, you'll be able to maintain your good premiums until the day that you die. You'll be able to adjust the amount of insurance that you have in force until the day that you die, and you'll be able to lengthen the period of time that that insurance will be in force. So when it comes to buying life insurance, we suggest that you call a licensed professional that represents a number of different companies, and that you get some information before you make your purchase. In other words, just think. This is financial planner Jim Tewalt, and until next time, just think.